IVM.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, P50 on Twitter, and this is the Wealth Management Special. I've always wanted to cover this topic, and finally I have a guest to do this. My guest today is Atul Singh, CEO at Validus Wealth, and we're going to talk a lot about wealth management, what it is, why we need it, etc. And don't worry, if you don't have a lot of wealth, I don't certainly. The concept is still very interesting, and you might want to hear about it. So now, of course, and therefore not all of us need a wealth manager because, like I said, we don't have that level of wealth. But there are still a lot of concepts on wealth management that are useful to all of us and probably are applicable across a lot of portfolios. So to discuss all of that, I have with me Atul Singh, CEO at Validus Wealth. Atul, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners. Let's start with a very brief introduction to yourself, your background, how you started Validus, and what is Validus all about. Let's start from there.
Thanks, Anupam. Thanks, and good to be here. Good to be talking to you. In terms of background, graduated from IIM Bangalore, first job in the US, worked in New York for about 6 years, then made my way back to Asia, worked in Singapore for 4 years, and then now last 10 years in India, mostly working with top-tier private banks, Merrill Lynch mostly. So I'm a long-term Merrill Lyncher. And then finally, last assignment was as CEO of Julius Baer in India. Before I founded Validus Wealth about 2.5 years ago. Objective was to again create a top-tier India homegrown private client business working with Indian families across their financial life. So that's in a nutshell the background.
Yeah. Very helpful. So I need to understand, first you could give us a brief introduction to the concept of wealth management that gives our listeners an idea of that. Maybe there are some people out there who might even need a wealth manager. But I have two questions there. One is, what exactly is your client profile, whether it's HNIs, whether it's family offices? And, honestly, I would have thought that already they are so rich, they are so well off. I mean, they probably have net worths of running into crores. Why would they need a wealth manager? So, two questions. What's your average client profile, and what does a wealth manager do?
So, I'll come to the second question first. So, wealth manager, Anupam, is like a doctor for your health. So, wealth manager is the same for your wealth, or I would say, we use a term quite often, financial health, right? So like you go to a doctor to really sort of do a diagnostic on if there is anything wrong with your health, and you have recommendations on how to improve your health, you could potentially think of a wealth manager in a similar light, right? And, we often talk about that having good financial health is not something that comes with just having a lot of money. So it's not proportionate. People can have a lot of money, yet they could have pretty bad financial health, and they would need help on many aspects. So in terms of high level, sort of 3 or 4 points that one thinks of with a client as a wealth manager, that is your money fully aligned with your objectives, financial objectives or life objectives that you have set for yourself, right? I mean, is it fully aligned? Is it helping you achieve those objectives, or is it not in line? Are you taking disproportionate risk with your money as you go about your life? Have you done enough planning to take care of any contingency that may come upon us? As you know, life is uncertain, the world is uncertain, but having prepared for these contingencies give you peace of mind. And then finally, we ask this question a lot to our clients that, okay, what will happen if the biggest contingency you get hit with, which is, let's say, if you are not there tomorrow, do you think your family will be able to sustain the lifestyle that you have created, that you have worked very hard to create, right? And I'm not talking about insurance. I'm talking about financial health of your family that can actually sort of sustain itself even after you. So, those are all aspects that go beyond telling you which mutual fund to invest in and which stock to invest in. So that, in a nutshell, I would say what a wealth manager does or should do, which is very similar to a doctor for your health. In terms of our target segment, Anupam, we are fairly sort of wide-ranging. So we do work with very large families in the country, because we wanted to not be classified as a mid-tier platform. If we didn't work with them, we could be, we could run the risk of being classified. And, the complexity that these guys have makes us smarter, makes us better. So we create a lot of stuff that is relevant to them. But we are also in the business of packaging all of that and bringing that down to a more mid-tier and a more wider clientele, which in our world, we call it emerging high net worth. So, a lot of young professionals, a lot of new business owners, etc., that may not have acquired a lot of wealth yet, but the path that they are on, because of the age that they're in, they would eventually create a lot of wealth for themselves. So we want to obviously start working with them fairly early. We also work with a lot of retirees who have worked all their lives and worked hard to create a corpus, and now with life expectancies where they are, they do need that money to be taken care of and be useful for sustaining their lifestyle, well into post retirement, as well as their next generation. So our client range is fairly wide ranging.
Interesting. So, Atul, you've spent time at Merrill Lynch, you've spent time at Julius Baer, and then you would know that outside of India, say in countries like China, Taiwan, Hong Kong, Singapore, wealth management industry is probably quite mature. Whereas in India, I think, from what I know, it's more of a recent phenomenon, because I guess serious wealth has been created only in the last 10 to 15 years, or not that. I would say that wealth has always been created in India, but looking upon it as a formal area of advice as a profession is more recent. I think that's what I want to say. So just walk our listeners through how the wealth management industry has evolved in India, say how things were, I don't know, maybe back in the 80s, 90s, or early 2000s, and how it's more organized and more professional now. Just to give an idea on the quality of advice, maybe the range of options, so our listeners can understand how wealth management really works.
Sure. So Anupam, you're right that the wealth management industry is a new industry in India, and it coincides with the first generation entrepreneurs making a lot of money. I mean, yes, the money was there in 80s and 70s as well in India, but that was concentrated in few groups, few large promoters. In a democratic sense, the wealth with the per capita income, increasing dramatically in the last 20 years, and the new age business owners, starting their business and creating a lot of wealth, has happened in the last 20 years. So it has taken a dramatic sort of proportion in many dimensions in the last 20 years. Just before I sort of talk more about it, just as a comparison,
sure,
as you mentioned in Europe and the US, the wealth management industry is actually entirely different. The fabric of the industry is very different. In Europe is a classic third generation, second generation wealth management industry. So what it means is that your core clients that you are serving are not the ones that have created wealth in their lifetime, but they have actually, most of the wealth has been passed on by the second or the third generation prior to them. Now, which is Europe. In the US, it's probably more second generation and a mix of first generation as well. I mean, a lot of the tech boom is first generation, but a lot of the broader wealth is still second generation. India, potentially similar to China, but India particularly is a first generation story, right? So particularly the clients that you deal with are the ones that have created wealth in their lifetime, right? And while it may sound subtle, but that's a very, very fundamental difference, the way the wealth is managed. Because in Europe and in US, and particularly Europe, because the contrast is the highest with Europe, the focus is on preserving wealth and growing at a moderate pace. Whereas in India, because you are talking to people who have created wealth themselves, the risk appetite for even managing their wealth, because they're sort of continuously running their own business, is still a lot higher, and focus is a lot more on growth and investment performance. So that's kind of one big contrast when you think about the wealth management industry elsewhere, in developed world particularly, and in India. So India, it's all about growth. It's a lot of it is about investment performance, etc., and also dealing with first generation entrepreneurs. Now, that's sort of one dimension in which the industry is different. But in terms of evolution, you're right. The first stage in any industry, when the industry is less sophisticated, is product pushing, right? So, it started with the stock tips and the stock trade. I mean, that's what wealth management was. Which stock is going to do what, and which operator was kind of playing on what stock. It moved to a bit more, mutual funds came around, etc. So it became a lot of product pushing on certain products with high commissions, etc. A lot of banks do this business or did this business so far because they are good in distribution. They are not good in the business of advice, but they are good in distribution because they have reach, etc. So they use their reach to push a lot of products out. But now we are entering into a bit more sophisticated sort of version of wealth management, where, of course, the inherent complexity in the marketplace has also gone up. So you have advent of, let's say, we call it portfolio management services, PMS, which allows, outside a very rigid framework of mutual fund, managers have the ability to really, create various strategies. And then now you have AIF, the alternative investment funds, where you have ability to take leverage. You can practically, use any asset class to create an investment product out of it, etc. So on the product dimension, on the level of complexity, the industry has evolved from, few stock trading tips, not even advice, but tips, to, packaged mutual fund product pushing, to more PMS and AIF. And now there is enough complexity, Anupam, that there is value in overlaying advice on top of all the products, right? So the final evolution of the industry is going towards the value of advice, and advice is sort of far-reaching. So that's the evolution that we have experienced, and wealth managers become far more valuable when you really reach that level of evolution where the focus is on advice and not necessarily on products.
Yeah, and I'm also sure that the type of assets are also very different, right? I mean, someone who has a fairly large corpus or assets under management could have a lot of land, could have a lot of gold, could also have a lot of stocks, and just necessarily doesn't have to be that. So So the last question on this part of the episode is, I want to talk about technology, Atul, right? Because like you said, since for the last 10 years, this field wealth management has also evolved. A lot of technology has also come in now. I don't know how advice was 10 years ago to, say, someone with a 50 crore corpus, and how advice is today to someone with the same corpus with technology. So are there any innovative solutions, for example, that have totally transformed the way wealth management firms work?
Sure, Anupam, and it's a great question. In fact, one of the building blocks for me to found Validus was the premise that technology is highly under-leveraged by private banking businesses, private client businesses, anywhere around the world. And as we know, technology is changing every aspect of our life, and delivery of financial advice is not going to be untouched with that. So, however, when it comes to high net worth individuals, we believe that technology cannot fully replace the interface with advisor, because financial advice is a lot about emotions, about empathy with the client, understanding the objectives and the mindset of the client, attitude of the client. So the advisor will continue to play a critical role, but the advisor can significantly be enabled with technology. So in a HNI, high net worth space, the real focus of technology will be to use its analytical power, to use its predictive power, access to market data, access to advice, to enable the advisor who's sitting in front of the client to pick and choose the power of technology to bring it to the client. But we don't believe that the advisor will be fully disintermediated by technology in any time to come. And one of our distinctive business models at Validus is combining technology with the power of human or advisor to bring a high quality, and high bar service levels or advice levels consistently to the client. Now, where technology will fully intermediate the interface is maybe at a lower level, maybe at a mass investing level, where if somebody wants to do a 10,000, 20,000, or even a 50,000 rupee SIP and wants to really invest in a diversified portfolio of mutual funds and has a particular risk appetite, a lot of that you could assess using technology and help intermediate that at very low cost, right? So there, what you're solving for is cost and a reasonable level of advice. It's not highly customized, but it's still good advice, but managing the cost. Whereas at the HNI level, you can't just solve for cost. You do need to really have the software aspects, and hence a hybrid model is what is beginning to succeed around the world. I mean, the robo-advisors, as they are called, again, have been successful at the lower end of the market, but as the asset levels grow, a right combination of technology and human is beginning to be successful. And again, I no doubt that human alone will actually get beaten sort of hands down by human plus technology at that level.
Okay, fantastic. Folks, that is the first half of our episode on the Wealth Management Special with Atul Singh, CEO at Validus Wealth. When we come back, we're going to give you some practical advice, make this really personal to you, and how you can use some of best practices from wealth management for your own portfolio. We're going to talk about all of that on the other side of this break, so don't go anywhere. We'll be right back.
Hello, everybody. Welcome to another great week on the IVM Podcast Network. If you're not following us on social media, please do. We're IVM Podcast on Twitter, Facebook, and Instagram. So it's been a great week on the network, as it almost always is. Let me give you a couple of highlights that you should definitely check out. Chiki Sarkar was on This Rounds on Me with Gauri Devi Dayal. Great conversation. I think you will really enjoy that. Shlok Ramachandran of our new show, Millennial Athlete, who guested on one of our older shows, Football Should Ball. He's a big football fan in addition to being a professional athlete. So I think it's a really interesting connection. And they had a great conversation about football just generally. Nankari, our new show about Indian food, hosted by Sadaf and Archit, talk about laddus this week and basically, how awesome they are. It's Diwali week, and I think that's an apt conversation for them to have. On the Wire Talks podcast, Siddharth Bhatia has a great conversation with Dylan Mohan Gray about his work on Bad Boy Billionaire, specifically around the Vijay Mallya episode. Definitely check out the conversation if you want to know more about that. And finally, let me recommend the Edges and Sledges Cricket podcast this week. They take a look back at the IPL 2020. They go over the final, Delhi versus Mumbai, and how that played out. And they also create their dream IPL 2020 fantasy team. Do check that out. I think you'll enjoy that as well. And with that, let's get you back to your show.
And welcome back to the Wealth Management Special on Paisa Vaisa. My guest, Atul Singh, CEO at Validus Wealth. On the first part of this episode, we spoke about the concept of wealth management, how it's evolved with technology. In this part, we're going to talk about practical advice to you. Okay, so first off, Atul, this is an important question, and I get it a lot from a lot of friends of mine who are just rushing around for advice. So I have to ask you, Just last week, I had posted this question on Twitter for financial advice and what stops people from, hiring, say, a financial planner, and I got a whole long list of answers. But of course, that is a separate set of people. For wealth managers, although I'm sure that, when you're looking for advice, whether it's for a portfolio of, say, 50 crores or if it's for 5 lakhs, there are certain principles that are pretty much the same. So can you just give us some tips and advice on both the sides? One, financial advice in general. How do you get good financial advice? And two, how do you actually choose a good wealth manager for yourself?
So Anupam, the largest or the most suited client acquisition technique for financial advisors is using referrals. Now, what it means is that, a good financial advisor always, in most cases, comes through somebody that who has used their services, right? So it's a very experiential business, right? So financial advice is not at all about the financial acumen or intelligence of the advisor. It takes a lot more than that, right? In fact, we have done, and as I mentioned, I was in the US for a long time and Singapore, and we have done this research in every market possible, asking this question to clients: what is their biggest driver of satisfaction with their financial advisors? And the single sort of biggest driver has been the reach out or engagement of the financial advisor with the client, right? So when the financial advisor reaches out, especially in the times of volatility, when everything is going good, you may not need them to reach out. But when things are not looking good, is the financial advisor, does he have the EQ to actually pick up the phone and engage and say that, hey, I have got your interest at the center of it, and things are in control, don't worry, right? Or if some changes need to be made, these are the changes need to be made, and these are the reasons why. So that engagement or that reach out is actually the single biggest driver of satisfaction for clients all over the world, right? And financial advisors need to understand that. Now, it's very difficult to judge that when you are really doing a beauty parade of financial advisors. And that is why I meant going through the referral way, where if you really talk to, and again, if somebody is not referring somebody to you, always ask the financial advisor to give you references, and do make sure that you talk to 3 other clients that the financial advisor has served. Because unfortunately, there is no empirical evidence that you could take a test on the financial acumen or the investment performance that the RM may have delivered, or the advisor may have delivered. Those are not necessarily the best drivers of the outcome. So reaching out to other clients that the advisor has served is probably the best way to really make sure that you actually get together with the right advisor. So that's as far as the advisor is concerned. I mean, don't get me wrong. Obviously, you're doing business because you want better investment performance. But like I mentioned, that there is risk management. There is also this whole attitude of the advisor who thinks of your money as if he's managing his own money, and the love and care he or she puts in managing your money. So those are all intangibles that are very difficult to judge in any parametric way. So that's why referral works very well in our business.
Atul, so, if I were to make a checklist of questions, maybe top 3 or top 4 or top 5 or whatever, what kind of questions should you be asking your wealth manager before you sign them on? Let's say that I'm actually doing, well, let's not call it a beauty parade, but let's say that, and I've done this with a couple of friends where they've asked me that, we need some help, some advice, and we don't really trust asking out in general. And I try and help them with some things or some people that I know directly from. Sure. But how would you approach this? What would be a very generalized set of questions that all of us should be asking our wealth managers?
Yeah. So I think so if you have an investment advisor sitting in front of you, and if you were to kind of ask these set of questions, I think the first question is understanding his or her investment philosophy and strategy. So just again, how he thinks about managing clients' money. A lot of qualitatives, a lot of subjective assessment there, but just listening to that is very important. Because again, like I said, there is if somebody to say that, look, I will beat the market 5 times out of 6 or 8 times out of 10 is not necessarily who you're looking for. Very, very important to really know. So understanding the investment philosophy and strategy, I would favor an advisor who focuses a lot more on risk management for you than actually return, because we always believe return is an outcome of risk, and what you can modulate is risk. You cannot modulate return. Return is an outcome, and it will happen based on the risk that you've taken. So understanding that philosophy and strategy is probably one key aspect. Second aspect I would ask is, how would you customize your work or your advice for me? Right? I think it's a very, very good question to ask that, look, how am I going to be different from, let's say, 5 other clients that you're serving, right? And in fact, you should ask the advisor to ask you 5 questions in assessing how we are different, or how I am different, right? That will immediately tell you how deeply the advisor is thinking about a particular client in a particular manner. And then the third is, of course, like I said, the type of clients that advisor caters to, and potentially asking for 2 or 3 references that you could potentially speak to. So that not just giving high-level references of the who's who of the industry that they serve, but clients that you can actually talk, right? And then I'm assuming, obviously, the education and the qualification and the certification is all taken care of. I mean, that's not necessarily what one has to sort of go. But these are the qualitative factors that will help you assess the quality of the advisor, because, like I said, it's a lot to do with the attitude, empathy, and the soft skills of the advisor, as much as it is to do with the hard skills of understanding the markets and the product.
Understood. Okay, let's get some, your views on how our listeners should manage their wealth in such difficult times. It's been about 7 months. God knows what's going to happen in the future. There is a certain set of people who were, lucky enough, or who had the risk profile to jump in the markets back in March, and now they would have made whatever they've made. But irrespective of that, in general, do you have any tips on how to manage our wealth, or maybe on asset allocation, just generally, in these difficult times?
Yeah, so Anupam, I would say that even at a higher level, even if you sort of pull yourself up one level on managing the financial life, right? And I think if I go back to March and the peak of the crisis, right, and there the level of anxiety was very high, and it's very easy to say that, hey, stick to asset allocation, and in the long term the market will do what it has to do, and you will be okay. But when you are hit with extreme uncertainty, and when it comes to your financial life, and hence your lifestyle being in jeopardy, then you take decisions that are not necessarily intellectually correct, right? So I had assumed at that time that the risk appetite for people would go down dramatically, because people's risk appetite would go down because I call it negative wealth effect, because everybody in the world would feel poorer than what they were before the crisis, right? And it is true. So your business may not be doing as well as it was. Your real estate, if you have real estate, or the house that you're living in, the prices may have been lower than what you thought. The stock may be down, the stock portfolio may be down, bond, currency. So anything that you held would be down. So there is a negative wealth effect that comes in. Now, the response to that is that you need to, my advice to clients is that do take time to think about the assumptions that you made about your future. Okay. Before I come to asset allocation, just from financial life perspective, just sort of step back, think about some of the assumptions that you made, right? Because many assumptions have changed, right? And again, the different assumptions would have changed for different people, but nobody can say that the assumptions would remain the same for people going through such a massive crisis. So think about those. So what it leads to is a lot of life planning, right? A lot of retirement planning, right? I mean, I'm 45 years old. Even I'm compelled to think about my next 20 years going through the crisis. I mean, how would it be? And do I have enough money if everything if my business goes down, if my portfolio goes down by 30-40%, do I have enough money to sustain my family's lifestyle, right? So a lot of retirement planning, and that's actually leading to real actionable points from the client, right? So, but thinking about that is important. Succession planning, right? I mean, if something were to happen to you, do you think your family will be okay? And again, I'm not talking about insurance. I'm talking about your financial life. Is it in a place where you could potentially disappear, and your family will be okay? And by the way, I'm not just throwing these questions. There are very, very clear answers to each of these, but it's very important to take time and think about it. And then there is question of so apart from retirement planning, succession planning, cash flow planning, there is question of asset allocation. And I think asset allocation is something that is a much abused word. It's theoretically very easy to understand, but it's very, very difficult to sort of implement practically. But nonetheless, one has to come back and think about maintaining an asset allocation. And if through the crisis, if you had maintained your asset allocation, if you decided to put 30% in equity, 60% in fixed, 70% in fixed income, if equities fell, you bought more because you wanted to get back to 30. And now if the equities is doing very well and you want to trim that and get back to 30, believe me, that works like a magic over a long period in time. Again, like I said, when you're in extreme stress, very difficult to stick to it, but there is no alternative to it. So from an investment core perspective, I would say getting back to your asset allocation is probably the only answer. Don't make knee-jerk reactions unless your retirement planning, cash flow planning mandates you to do that, right? So for example, if I have sustained so much damage that my business is gone, my cash flows are gone, that to sustain my family's lifestyle, I need to make certain changes in my risk appetite is not as much as it was there before the crisis, and I need to really take the equity exposure down. So be it, do that. But if your financial planning, cash flow planning, succession planning, all of that kind of shows the sort of the right frame, then stick to the asset allocation that you decided. Make minor changes, but don't make wholesome changes unless you have to. So it's a lot of work. The one advice I would have, Anupam, for our listeners is don't leave the status quo. Don't assume that you don't want to look at it and everything will be fine in the long term. No, these are important aspects. One has to step back and think about it deeply. Times like these are triggers for when you have to think about it in a lot more urgent fashion.
Okay. Atul, so obvious question. Coming from the advice that you gave on asset allocation, what's your outlook? Across asset categories, across markets over the longer term? Because I assume that when it comes to wealth, we don't want to know what's going to happen tomorrow or in the next year or that. But what's your general view on asset by asset outlook over the medium to the longer term, given that we are in this whatever you call it downturn or crisis or whatever?
Sure. So, Anupam, the way we think about asset allocation for any investor, unless I get a specific feedback from the investor where our starting point is what I call one third, one third, one third. So, one third in long only equity, one third in long only fixed income, one third, very, very important, one third in what I call market neutral products, which are uncorrelated to equity and fixed income markets, right? So that's kind of our starting point. Now, obviously, you overlay the risk appetite and one goes up or goes down, but that's sort of our starting point. Now, if I go, and I'll talk about what I mean by uncorrelated asset classes or market neutral products, but going sequentially, so equity, Anupam, India is a land of entrepreneurs. There are fantastic companies, taking shape every day, being scaled up, etc. India has high inflation, and equities is, other than real estate, equities is the only other asset class that is inflation adjusted. So equities continues to be a very, very important asset class for Indian investors. The nominal GDP of the country for the last 20 years, 25 years was 15%. Nominal GDP is a sum of real GDP growth of, let's say, 7 to 8% plus inflation, which was also 7 to 8%. So the sum of that 15%, and the earnings of the companies would appreciate at similar rate to the nominal GDP, which is about 15%, and hence the stock market, by and large, barring the short-term movement, would also give you 15% return, which is the history. Last 20 years, 25 years, that's the history. That is changing a little bit. Now the inflation is coming down. With the targeting, particularly by the monetary authorities, the targeting on getting the inflation down. So the nominal GDP of the country in the next 10, 15, 20 years is not going to be 15%, but it will be more like 10 to 12%, right? So I think the targeted returns on equities, one has to really take their expectation down, but still 10 to 12% compounding on equities as an asset class is there to be taken. Done sensibly, you would get that. You don't have to be very precise in picking the next multi-blagger, etc. If you have a good quality, hygienic portfolio of companies, you would get that. You would get that over a long period in time. So, and by the way, that's not what you can say for many other asset classes around the world. We do a lot of global investing without being very precise. Getting a 10 to 12% compounding in Indian rupee is not to be kind of trifled with. So very important, and hence some allocation should go there. Of course, with that you have to bear the volatility, but the history suggests that if your holding period is long enough, 18 months, 2 years, 3 years, you have practically no risk of at least losing money. The second component is fixed income, because investors say that, hey, if I can get 10 to 12% anyway in equities, why do I need fixed income? You need it because there will be volatility, and you would not like to see your portfolio go down by 10, 15, 20% at any given point in time, which it can happen if 100% of it is in equity. So you need fixed income because it provides defensibility. In fixed income also, the long-term trend is for the rates to come down. The country, we feel that for secular growth in the country, the interest rates have to be much lower than what it is today. The borrowing cost for the companies will have to come down for them to be competitive in domestic market and international market. So the yields will continue to come down. I think 7 to 8% is a fair assessment of what you can generate in fixed income over a long period in time, with a mix of various credit companies. So AA, AAA, as well as a little bit of single A, a mix of that, 7 to 8% is what you can expect. And then the third category is what I call market neutral, where you are picking asset classes which are uncorrelated to equity and bond market. There are lots of products or asset classes emerging. Gold continues to be a very important asset class there. Provides hedge to the portfolio, provides defensibility to the portfolio. Some allocation to that is important. Now, REIT in India, the real estate, which also is another inflation-adjusted asset class, but of course, for obvious reasons, doing directly is highly inefficient. Investing money in real estate. Of course, Indian investors have been investing a lot of money there, but now it is available in securitized form. So REIT is another asset class there. You have some arbitrage products. You have anything that doesn't correlate directly with equities and bond market movement is classifies to be there. So those are the three asset classes. You got to really put a layer of risk management. Be safe in picking these instruments. But if done right, the right combination of these three asset classes have the potential to generate significant risk-adjusted return over a long period in time without too much of volatility.
Understood. That's very helpful, Atul. Third and final question, and this goes out specifically to our NRI listeners, because I keep on getting questions from them. Do you have any, let's say, specific tips for them? Because the kind of questions I get are twofold. One is, sitting in US or Europe or Asia, wherever they are, what all can they really invest in India? I mean, they're obviously investing in stuff in their home country, which could be, like I said, US, Europe or Asia. But if they want to invest in India, one, any advice there on what they should be looking at? And two, the tax angle. What are tax efficient ways for them to manage their India assets?
Yeah. So, Anupam, I mean, there is another interesting angle. So one is, of course, NRIs looking from outside into India. But one aspect we didn't touch, which, we think a lot about and we do a lot of work, is Indians investing abroad.
Oh, yeah, right? That's become a big trend, apparently.
So that's a big channel. Because we fundamentally believe, and I'll come to your specific question, but I'll just touch on this, that we fundamentally believe that Indian families have to globalize a lot more than what they are today, right? And again, like I said, technology and use of technology was one tenet of us founding the business at Validus. The other is around helping Indian families globalize. And there also you need high quality advice to be able to really venture out outside India. It's not just about buying Apple and Google, but again, it's about building a diversified portfolio. And how do you do that? And what are the right products? What are the products that have tested the time over a long period in time, etc. So again, a simple asset allocation, etc., could be applied there as well. But very, very interesting opportunities. But more importantly, almost I would say a necessity for every Indian family to look to put some money in non-Indian rupee product or asset class, because Indian rupee will continue to have depreciating bias. And in fact, we go to a point where we say that, look, long-term wealth sustenance is just not possible if you have all your money in single market, single currency, right? So that's very important aspect for Indian investors to think of. And again, we put that also in the third bucket of more market neutral when it comes to Indian market Indian market related correlation. So very important to do that. Now coming to the NRIs, like I said, India is a land of entrepreneurs. The asset class for Indian equities is something that is unique for anywhere around the world, right? I mean, you do have if you had picked technology companies in the US or China, consumer plus tech companies, you would have done very well in the last 10, 15 years, but you need it to be right. There are hardly any markets where on a broad-based basis, the fundamental demographic and fundamental economic activity lends itself to 10 to 12% growth rate, right? So Indian equities by far is an asset class that every NRI, every investor around the world, in fact, should have in their portfolio. Indian debt is of not significant value because the NRIs as well as other global investors have ability to leverage and borrow at very cheap cost. So the trade of borrowing at 0.5% and investing in a 3% debt will still give them 5-6% dollar returns. So there is limited value in investing in Indian debt, but Indian equities with that kind of natural compounding rate is definitely a very, very good asset class. And we have seen that with foreign investors' interest in Indian equities as an asset class. I mean, as you know, from 2009, 2010 onwards, 45% of the Indian stock market float is owned by foreign investors. And that's the lure of Indian equities and the compounding that it can deliver. So NRIs, or for that matter, any global investor should not be untouched with that. And so that's clearly a very strong endorsement that I would have for Indian equities as an asset class. In terms of taxation also, it's the money that gets invested in India for NRIs, they have to pay taxes on that money in India. So, the same long-term 10%, short-term 15% capital gains, which is very efficient. It's not too much. It's not too tax inefficient for NRIs. They will have to file taxes in India on the money, on the gains that they make in India on equities investing. So there is no other way to sort of go around it, especially for NRIs. Foreign investors do have an opportunity to invest through FII vehicles, etc. But NRIs have a privilege given to them. I call it a privilege given to them to be able to invest in Indian markets directly and buy whichever stock they want and participate in the growth story of India. So they should do that. And taxation is less of an issue because, yes, it was, the long-term taxation was 0 before. It's 10% now, but it's not prohibitive by any stretch of imagination.
Fantastic. Atul, thank you so much for doing this for our listeners, folks. That was the wealth management special. I had with me Atul Singh, CEO at Validus Wealth. You want to know more about Validus? Their website is validuswealth.com. That's VALIDUSWEALTH.com. Atul Singh, CEO at Validus Wealth. Atul, thank you so much for doing this for our listeners.
Sure. Thank you, Anupam. My pleasure.
And listeners, if you like this podcast, don't forget to check out other interesting podcasts on IVM Network. You can listen to us on the IVM Podcast app or IVMPodcast.com. You can also follow us on our social media. We are IVM Podcasts on Twitter and Instagram. If you want to reach out to me, I'm B50 on Twitter. And thank you so much for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Are you looking for India's most awesome cricket podcast? Are you now tired of listening to the same old guys drone on about cricket everywhere? Edges and Sledges is a weekly cricket podcast hosted by 3 fans of the game, Varun, DJ, and myself, Ashwin. It was established in early 2018, has over 60 episodes now, and is of course now proud to be on the IVM Podcast Network. Each week, we get together from 3 different time zones, the USA, the UK, and Singapore, and we talk about things from the world of cricket, with a focus on Indian cricket. We often interview special guests from all around the world, including former cricketers and cricket media personalities. So check out Edges and Sledges, the cricket podcast, now on the IVM Network.
Namaskar, dear Bandhu. My name is Ashish Vidyarthi. These are truly challenging times, and in these times, we need hope. Do take time to listen to my podcast, Begin the Journey. Available on IVM Podcasts, website, app, or wherever you listen to podcasts. Remember, there is hope because there's one life and we are alive.